We have seen that Basel 2.5 addressed some of the counterparty credit risk, but Basel III further consolidated on that and has enhanced the counterparty credit risk measure. Either you take a original exposure method or current exposure method in both the standardized method or IMM. And most of the derivative transaction to arrive at the positive exposure on the counterparty, it was suggested that use the stress inputs. So rather than using the normal ones, use the stress input to compute the kind of exposure you will have on the counterparty. So there were some additions like credit value adjustments for the OTC derivatives, wrong way risk since you are using the same input for PD and EAD computation, and asset value correlation of 1.25. This is what we say is to address the systemic issue. So if you have a counterparty who has a balance sheet size of $100 billion and above, if your risk weights are 100, it will become 1.125. So basically there is a asset value correlation factor of, so you need to maintain a higher capital when you are having a counterparty whose size is $100 billion and above. So additional measures were also suggested for the collateral management in case of OTC derivatives, and in the crisis most of the banks were failed because of the position in the OTC derivatives. And there was the Basel III want to incentivize for the central counterparties, so that most of these OTC derivatives which create additional counterparty risk for the banks can be taken on the central counterparty like your exchanges and settlement agencies. Now this is one important ratio because when you maintain a capital based on the risk weight, depending on the risk weight your overall capital ratio may look good, but to restrict the growth of the banking assets, the additional ratio of which is known as a leverage ratio was prescribed. Here the numerator is purely a tier 1 capital, and the denominator is on and off balance sheet exposures, credit equivalent with 100% credit conversion factor, except 10% credit conversion factor for unconditionally cancelable off balance sheet commitment. This is very important. So it is taken on the gross value. All your collaterals are not to be considered. So it definitely will have a dampening impact on the credit expansion of any banking organization, because the ratio has been prescribed at 3%. Now, how does the additional systemic risk and interconnectedness issues are handled? One is the capital and liquidity surcharge on SIBs and basically the systemically important banks and systemically important financial institutions. Activity restrictions on exposure on SIBs and CC. When if you are a bank, you are not part of SIB or CP, then you need to have fix up some exposure limits on these SIBs and CPs. Intensive supervision, that's the regulators will have more rigorous inspection as far as SIB, CPs are concerned. And the asset value correlation we have seen, if you have an exposure on the systemically important bank, you need to have a 1.25 multiplier for the risk weights for maintaining the capital. And there is stricter treatment of OTC derivatives not cleared through CCP. So this was basically to incentivize banks to move into settlement of the derivatives through the CCPs. And the improving loss absorbing capacity of the CBs by contingent, prescribing contingent capital and bail-enable debt, basically the debt which has the features, in case of a requirement, the debt getting into the shoes of the equity. So it has the loss absorbing capacity. Now, the important factor in addition to the leverage ratio, additional capital prescribed, two important ratios have been prescribed for the banks, which will address the liquidity aspect, liquidity standards. And one of the first ratio is liquidity coverage ratio, because they say internationally, if your bank is good enough as far as the liquidity in the next 30 days is concerned, I mean, that's the most of the horizon which is being closely monitored by most of the regulators. So they wanted to have a liquidity coverage ratio of more than 100%. And here the numerator is basically high quality liquid assets which can be encashed in any market condition. That's how we define the high quality liquid assets. And the net cash outflow, this outflow is in a stress scenario, acute stress scenario, where there is a sort of a run, not exactly a run, but there is a withdrawal of deposits, and whether the bank can sustain this kind of not a very common feature for the next 30 days. So this ratio is expected to be more than 100%. Second is about how the banks themselves are funding their assets. So it also stress about the stable funding ratio, which basically talks about the 1 year horizon. What is required in the next 1 year and what is available as a part of stable funding in the next year, because this ratio is computed using different risk weights for different kind of the source of funding. To address the issue of mismatch in the banking book, another ratio, net stable funding ratio, which basically will address the mismatches in the liabilities and assets maturities, was stipulated, basically considering 1 year horizon. And what is the available amount of stable funding? All the sources of funding, whether it is bank, long-term funding through corporates or retail, will have different the factors. So when you convert them, like we convert the risk weights using the risk weights in case of a credit risk, so what you get is the stability kind of a ratio. So available amount of stable funding divided by based on the expected outflows, required amount of stable funding, the figures are calculated, and this also ratio has to be more than 100%. So other monitoring tools, so like we have the existing one, contractual maturity mismatch, which is, and then concentration of funding. So if a particular bank is more on the wholesale funding, doing its funding only through wholesale, then it will have that concentration of funding and it will have a problem in meeting this stable funding ratios. And it also stresses about the availability of unencumbered assets. So basically the assets which are not in the repo and all, totally free and readily available for the bank whenever it has a liquidity issue. And it also stipulates currency-wise liquidity coverage ratio if your bank is exposed to a particular currency. So there is a liquidity coverage ratio mentioned depending on for each of the significant currency. Now, what are the implications? Some of the results of the studies conducted by the IIF says there could be a loss of output of 3% during this implementation stage. Basel, the committee study has a lesser impact. It says 0.2% on GDP for each year for 4 years. And there's 1%, if the capital has to go up by 1%, that is the tangible common equity, which is proposed to go up substantially in the Basel III. It will impact 0.2% on GDP for 4 years. And that's what is expected because the banks will have a better balance sheet. It is expected that the long-term gains are very, very immense. But immediately it is expected that there could be gaps in the liquid assets which are required to maintain those LCR and the NSFR, and the lot of big banks could face a capital shortage in common equity because the tier 2 capital has to be literally now replaced with tier 1 and that too equity. So that the banks could face shortfall in the common equity. And in the tier 1 itself, some of the deductions will reduce the tier 1 capital itself because some of the exposures which were earlier risk weighted has now to be deducted from tier 1, which probably will have a larger impact on the capital adequacy ratio. Of course, the Basel III, there is a provision for long phase-in arrangements, considering some of the issues like, what the regulator also expects, that it is not easier for the bigger banks to adjust to the new norms. So these are the transitional arrangements RBI has prescribed. The minimum CET1 has to move from 4.5 to 5.5 by 31/3/18, and the total capital has to increase from 9 to 11.5% by 31/3/18, and so far the counter-cyclical buffer has not been identified because it is for the regulator to prescribe. So we will see what the counter-cyclical buffer and the capital conservation buffer is. Now, the Indian bank impact, definitely it's going to impact the Tier 1 capital, because most of the Indian banks don't have that kind of a trading book. They may not be affected much because of the new guidelines. And Tier 1 capital always has been quite comfortable as far as the Indian banks are concerned. But one of the important issue is whether the SLR securities will be considered for the LCR ratio. That is not very clear so far, and whether it will stand the test of marketability which Basel is prescribed. Now this basically the composition is basically to summarize what we discussed about the Basel III. One is capital reform, then liquidity standards, and systemic risk and interconnectedness issues. So basically in the liquidity we have seen that it has addressed the liquidity issue by prescribing LCR and NSFR, and the capital reforms by quality and also by the buffers and additional control using the leverage ratio. So the functioning of the two additional capitals, capital conservation buffer is above the minimum requirements. So capital conservation buffer and counter-cyclical buffer each can range from, conservation buffer has to come out of the common equity Tier 1 capital, and the counter-cyclical buffer has been prescribed, and it is left to the regulator to prescribe this from 0 to 2.5%. So there is an additional requirement of 5% over the minimum requirement. And the capital conservation buffer is basically to preserve your capital, and when you are doing well, there is a tendency that whether you are making a profit or not, there is a dividend distribution. Basically the capital conservation buffer has to ensure that you maintain your capital above a minimum requirement when you are making profit, so that you can draw it whenever you have a problem in the future. So it has a lot of restrictions on the distribution. So you cannot distribute part of the capital conservation buffer as dividend, bonuses, like that. The counter-cyclical buffer works by extending size of capital conservation buffer during period of excess credit growth. This is for the regulator to decide when to prescribe and what should be the period which should be considered for to be considered as a excess credit growth. Based on that, the regulator can prescribe when credit growth, say if normal credit growth is 15%, if the industry is growing at 25%, they may come out with additional capital requirements to meet the counter-cyclical capital buffer. Because the tendency is banks are volunteering to lend when the going is good, but suddenly they apply the brakes when the economy slows down. So this is to take care of those issues. So objective is, again, like we discussed earlier, buffer above the minimum, build capital buffers in good time, so it can be drawn during stress. So it ranges from 0 to 2.5 above the minimum. Now, let us just compare without going into the details of each of those guidelines, where the RBI guidelines are stringent than the Basel guidelines. We know that when the Basel has prescribed 8% capital, RBI already has prescribed 9%. So to that extent, there is no additional capital, but Basel III, the capital has to be met through the equity. So we can say that the effectively the common equity capital at 5% is 1% more than the Basel 4.5%. Total capital must be at least 9%, so against the 8% which is prescribed by the international regulator, that is Basel. And another important part is the restriction on the Tier 2, which has been capped at 2% of the risk weights, whereas no such caps worldwide. And another restriction which the RBI regulation has is additional Tier 1 instruments cannot be issued to retail investors, which will reduce the investor base for banks' capital instruments. So basically, this is another challenge when you cannot issue it to the retail investors. So it has to be through a private placement. So leverage ratio, RBI has stipulated 5 against the BCBS 3%. So it further puts Indian banks maybe in a not in an advantageous position compared to the other banks. But Indian banks, though being very, they don't have a bigger off-balance sheet exposure like derivatives. Generally, they are comfortable as far as the leverage ratio is concerned. But definitely going forward, it could probably have an impact on the bank's growth. So, and another important factor is the uniform 100% CCF for all commitment except commitments that are unconditionally cancelable. So this will have a very large impact on leverage ratio, because all your unutilized cash credit overdraft facilities will have a 100% credit conversion factors. See, some of the issues for the Indian banks are not different. Some are common for all the banks internationally, like additional capital requirement definitely is a challenge. And raising Tier 2 capital with loss absorbing feature, this is going to be a big challenge, because literally you issue a bond and it will have the features of the equity. Whether the banks will be able to raise that kind of a capital in the current market, there's a big question mark on that. Definitely, we have seen that it's going to impact the credit growth, so it could act as a growth barrier for the economy. Because of the leverage ratio, since your off-balance sheet exposure gets restricted, wherein your profitability is more, probably it could impact the profitability of the banks. And implementing the counter-cyclical buffer is yet to be known how it's going to impact and what kind of counter-cyclical buffer will be prescribed by the bank. And another important factor will be the need to improve the risk management in the banks. So this is going to be a real challenge for the Indian banks. And with 27% CRR and SLR, whatever major portion being impounded in the statutory reserves and cash reserves, whether if these investments are not considered as part of liquid assets, then whether the banks will be required to additionally maintain liquid assets to take care of the BCBS Basel norms. That's one thing. And additional capital charge for domestically systemically important banks. This is going to again some of the larger banks will have an additional capital charge. So definitely it has an increased cost, whether it is domestically, internationally, because the market will accept a lot of banks entering the market for raising the capital. So probably there will be increased capital cost. Definitely the increased cost of capital needs to be passed on to the customers. Probably there could be additional, the cost increase in the banking service cost itself. So probably that could lead to a lot of corporates going directly into the capital market. So data will become a major challenge, whether it is market risk, credit risk, or operational risk, because all your models, everything requires a very data intensive. So it's going to be a challenge for the bank. And need to have a centralized data for periodic stress testing. This is one of the requirements of the Basel III. Periodically, banks need to conduct stress testing to arrive at the kind of capital required to meet market operational and credit risks, and that has to go into the capital planning of the bank. So this is going to put extra impact on the capital requirement. Friends, let us check our progress after discussing for almost more than an hour about the Basel Committee and their implication on the banking industry. Which one of the following is not the primary objective of BCBS? This is the Basel Committee for Banking Supervision. Standardizing banking regulation across the jurisdiction. This definitely was one of the objectives. To control global monetary inflation is not for the regulator to do it internationally. To maintain level playing field for fair competition by prescribing minimum capital requirement for banks, and to avoid systemic risk in banking sector. So A, C, D are the prime objectives of the BCBS. So correct answer is B, control global monetary inflation. Basel II Accord stipulated capital charge for the first time for which kind of a risk? We know that the Basel II first time brought in the charge for operational risk, so B is the correct answer. What is the important innovation of the standardized approach for credit risk? We know that in the standardized approach, if there are NPAs and without a threshold provision, minimum provision prescribed by the regulator, irrespective of the original rating, whether it is AAA, AA, has to be risk weighted at 150%. This is one important innovation of the standardized approach for credit risk. So tier 2 capital not to exceed tier 1, these are definitely not the innovations of standardized approach. The correct answer is A, NPA without a threshold provision to be risk weighted at 150%. Under FIRB, Foundation Internal Rating Based Approach for computation of credit risk capital, regulators, that's basically the RBI, provides all the 4 parameters: probability of default, loss given default, and exposure at default and maturity. Only EAD and M, maturity, only LGD, EAD and maturity, and only M. We know that in the FIRB, banks have to compute the probability of default themselves. All other risk parameters are provided by the RBI, so the correct answer is C.